Hello, my name is Shoaib Akhtar. I'm a senior investment analyst by trade. I've worked in the industry for over a decade. Today I'm going to talk about how do you protect your portfolio during a market crash, or if you're expecting markets to enter a difficult market environment. There are various ways to protect your portfolio during a market crash. Today I'm going to use crash approach. CRASH. So start off with C. We start off with cash buffer. If you are expecting market downturn, if you are expecting markets to correct or enter a bear market, and if you are uncomfortable with the level of volatility, you can simply de-risk the portfolio. De-risk means reduce risk by increasing cash allocation, i.e. by trimming some of the holdings, maybe more speculative holdings within the portfolio, and increase the level of cash within your portfolio. Cash obviously reduces the volatility in the portfolio, and cash sort of gives you that dry powder or opportunity to buy better quality stocks, maybe later on, further down the road when markets go down. Obviously, it's very difficult to time the market, so I don't recommend that, but this could be one of the strategies to temporarily de-risk the portfolio during a market downturn. Another approach which could be sort of utilized is rotation from some of the more speculative sectors like technology or software, and rotating from those sectors into more defensive sectors of the market, for instance utilities, healthcare, etc. Because during a market crisis, people still need to use electricity, they still need water, they still need transport, and they still need to use the toothpaste if that makes sense. So you could sort of rotate from more riskier, esoteric or speculative or adventurous areas of the market into more safer, defensive areas of the market. Another thing which you could consider is add protection by buying derivatives, put options. So what is a put option and how does it protect you? A put option is a derivative contract or an insurance contract. So you buy insurance. So you buy, for instance, if you hold a certain stock, say if you have investments in Nvidia, and if Nvidia is currently trading at $200 a share, you can buy put options with the strike price of $190, which means if the price of Nvidia goes below 190, drops below that level, then you have a right to sell at $190, but no obligation. So you don't have to sell, but you have the right to sell. In order to buy that put option, to buy that insurance, obviously there's a cost involved. For instance, if it costs you $5 to buy that put option, then your actual profit would only start after taking into account the cost of the put option. Let me give you a bit more detailed example around this. Say the current price of Nvidia is $200. So you buy the put option for $5 with a strike price of 190. Okay, and let's suppose your prediction or your thinking materializes and Nvidia falls, the price declines down to $170. But because you bought that put option with a strike price of 190, you have a right to sell Nvidia at $190, not 170. So your profit would be the difference between 190 and 170 minus the cost of put option. So you paid $5 to buy the put and you are making $20 gross profit, the difference between 190 and 170, right? So the net profit is $15 per share. And the put option also apply to the indices, for example FTSE All shares, or UK stocks like Next, etc. So you get the picture. So this is another way to hedge your portfolio if you are worried about a market downturn or a difficult period lying ahead. As we have seen, off late, there's a lot of volatility stemming from the events in the Middle East. Another thing you can consider is by adding alternatives. Alternatives are asset classes which tend to have low or negative correlation with the other mainstream asset classes like stocks and bonds, etc. So within alternatives, you can buy commodities like gold, etc. You can buy infrastructure funds, you can buy utilities, all sorts of funds, because some of those alternative funds, they have contractual cash flows, which means even if there is a temporary inflation spike, your return stream or the return or income you receive from those funds is index linked, which means it simply gets passed along to the end customer. So the level of income received from those investments goes up in line with inflation. So there is this element of inflation protection. If you are worried about market volatility, too much ups and downs in the market, you can consider market neutral hedge fund strategies within alternatives. So they tend to generate return from a relative market performance rather than the direction of the market, if that makes sense. Hedge funds, the market neutral hedge funds, they aim to make money for the investor regardless of whether market is going up or down, because these are relative strategies, if that makes sense. So and the last thing when I use my crash approach is you can hedge your portfolio. How? You can hedge your portfolio by reducing concentration, sectoral concentration, or stock level concentration within the portfolio. What do I mean by that? Say, what you would need to do, you would need to look under the bonnet and see what is your sector exposure within the total portfolio. If 70% of your portfolio is exposed to technology sector, which is mainly based in the US, then you can simply de-risk the portfolio by changing that sector split. For instance, you could reduce exposure to tech stocks and add maybe a bit more to financials, or healthcare stocks, etc., if that makes sense. Or you can even, there are various ways to skin the cat. If you've got quite a bit in growth stocks, you can consider investing into value stocks, which are more cash generative, more safer investments. So you can look at the sector level. Okay, so this is another way of sort of varying or changing your existing exposure to these speculative areas of the market. I hope that gives you a bit of an idea of how institutional investors or even novice retail investors can temporarily, add an element of resilience and defensiveness within the portfolios during a difficult market environment. But I must stress that markets have seen these events time and again. Over the last 50, 60 years, we have seen almost 5 big crashes. But when you receive the headlines, when you look at the headlines almost every day, there are talks of a market crash, market correction. But in reality, markets always tend to find a way, looking at the historical evidence, of navigating these risks, etc. Talking about oil, for instance, we have had some major oil shocks in the past, from the 1970s, in the 1990s, again in 2003 during the Iraq War, and also in 2019. So markets have, are sort of getting used to this. At the moment, I think there is ample supply within OPEC countries, etc. But you get the picture. To me, one of the core investment philosophies, investment theses, which I strictly adhere to, is timing the market is fool's game. It is very, very hard to consistently and successfully time the market. To me, it is time in the market rather than timing the market, which helps you generate and grow your wealth over the long term and differentiates winners from losers over the long term, because time in the market helps you protect and grow your wealth through the power of compounding, which is very, very powerful. Let me give you an example. People who panicked during the COVID drawdown, when markets were down about 20-30%, and they sort of jumped off the ship, they didn't take part in one of the sharpest recoveries, V-shaped recoveries that we saw in 2020. That was one of the strongest in the history of the stock market. That was one of the sharpest recoveries that we saw during the COVID time. So people who panicked, who sold at the bottom of the market, they didn't benefit from that rally or that recovery that followed afterwards. So this is my key investment philosophy, that it is time in the market rather than trying to be clever around timing the market. So I hope that gives you decent information, decent flavor, decent color around how institutional investors go about protecting their portfolio. And the same strategies or tips could be utilized, could be employed by novice or retail investors to temporarily de-risk or hedge the portfolio during a difficult market environment. If you found this useful, please feel free to subscribe, and I'll see you in the next video. All the best.